Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. It is Friday, January 30th, 2026, and the markets have certainly given us plenty to talk about this week. Today, we're breaking down one of the most interesting and I think misunderstood companies on the market, the German industrial software giant, SAP SE. Now, I know what you're thinking. SAP. It just sounds like, boring back-end infrastructure.
Right. Not exactly a sexy name.
Not at all. But what we're actually looking at here is the operating system of the global economy. I mean, we are talking about a company with a market cap of around 228 billion euros, currently trading at roughly $200.21 per share.
It's a behemoth.
It's a behemoth. And on the surface, it's this massive, stable business. But the real question for us as long-term investors is this. The stock has sold off, and I mean sold off aggressively, after their Q4 print because of a so-called backlog miss. So the market is panicking. The narrative is that the growth story is dead. So, is this a structural failure in their cloud transition? Or are we looking at a rare arbitrage opportunity where the market has just fundamentally misunderstood the physics of enterprise software?
Yeah.
Are there cracks in the fortress, or is the moat wider than it's ever been? That's what we're here to find out.
That's a huge topic, and frankly, the market reaction has been, well, it's been fascinating to watch. Before we dive deep, a quick heads up for the audience.
Right, so if you're looking to invest, we use Interactive Brokers. You can use the link in the description, and you'll get a stock bonus when you sign up.
It's the best way to get a bonus, and it really does support the channel at the same time.
And while you're there, please like, subscribe, and, let us know your questions in the comments. We do read them.
Now let's get into it. And I think the first thing we have to do is address the immediate volatility. Because if you looked at your screen this morning, you just saw a lot of red.
Yeah, let's set the scene. It's January 30, 2026. If you pull up a chart of SAP, you'll see a pretty distinct, pretty sharp pullback. We aren't anywhere near those highs of 2024.
Not even close.
Back then, the PE ratio was stretching over 50 times. I mean, that was frothy.
That was very frothy.
Today, we are sitting at a trailing 12-month PE of about 33.1x. And if we look forward, using the 2026 estimates, we're trading at around 23.4 times forward earnings.
Which, just to pause there for a second, that is a significant contraction. A 23x forward multiple for what is essentially a software monopoly with, incredible pricing power it's interesting.
It's very interesting.
It puts it in a territory where, value investors start to sniff around. But we have to address the elephant in the room. Why did the stock drop? Why is the market so nervous? Because stocks don't just drop 10 or 15% without a narrative, a story forming around it.
And it all comes down to one specific metric in that Q4 report. The backlog. Specifically, the cloud backlog growth decelerated to 25% in constant currency.
25%.
Now, to the uninitiated, you hear 25% growth, and you think, that sounds pretty good.
Yeah, most companies would kill for that.
They would, but the market absolutely hated it.
Well, in the SaaS world, or, the cloud software world, deceleration is a 4-letter word. It's poison.
It really is.
You have to understand the psychology of the growth investor. They're betting on a curve that goes up and to the right, and ideally, it's accelerating. So when you see a metric like backlog, which is, for all intents and purposes, your future revenue locked in a contract, when you see that slow down, it just rings every alarm bell on Wall Street.
Exactly. The narrative that's taking hold right now is cloud fatigue. That's the term you're hearing. The argument is that the easy money has been made, the low-hanging fruit has been picked, and now SAP is hitting a wall.
Right.
Investors see that 25% number, and they just think the transition to the cloud is stalling out. They look at the macro environment, they see high interest rates, they see geopolitical tension, and they assume CIOs are tightening their belts.
It's a classic, almost knee-jerk reaction. I mean, if the backlog is cracking, isn't that the leading indicator that the growth engine is fundamentally broken? That's the skepticism I'm seeing everywhere.
It is.
People are worried that this macro tightness is causing CIOs to pull back on these huge multi-year transformation projects. And the logic is simple. If you can't grow the backlog today, you can't grow the revenue next year. And if you can't grow revenue, well, that premium multiple you were enjoying in 2024 just evaporates.
That is the fear. And honestly, looking at the headline number, it's a rational fear, I get it. But let's unpack this because I think, and I know we've discussed this offline, the market might be missing the forest for the trees here.
Okay.
I would argue that this backlog deceleration is a timing issue, a temporary thing, not a structural failure.
Well, play the devil's advocate for me for a second. Why shouldn't we be worried? If I'm an investor holding the bag here, watching my position drop, 25% represents a slowdown. Why is that not a clear signal to sell?
Because you have to look at the unit economics. You have to look under the hood. If you strip away all the noise and you look at the cloud ERP suite, I mean, the core product, the thing that actually matters, growth, is still sitting between 28 and 32%.
Okay, that's a different number.
It's a very different number. That is not a stalling business. That is a business growing at a third of its size every single year at a massive, massive scale. We aren't talking about a startup growing off a base of $10 million.
No.
We are talking about billions in revenue growing at 30%.
That's a crucial distinction. The headline backlog number, it captures a lot of different things, some legacy stuff, some ancillary products maybe, but the core ERP suite is the engine. It's the absolute heartbeat of the company.
It's everything.
And if the heartbeat is still pumping away at 30%, then the patient is alive and kicking. And there's another metric that I think completely fundamentally counters this broken growth narrative.
Oh, I know where you're going with this.
And that's margins.
Oh, the margin story is just beautiful. This is where the whole bear case starts to fall apart for me.
It really is. So cloud gross margins have expanded to 75%. That's up 1.7 percentage points. Now, why does that matter so much?
It proves pricing power.
It proves pricing power. In a commoditized market, or a market where your demand is falling off a cliff, what do your sales reps do? They discount. They slash prices just to get the deal across the line before the end of the quarter. If that were happening here, you would see margins compressing.
Exactly. You'd see them buying revenue, as they say.
Right, but we're seeing the complete opposite. They're effectively raising the total cost of ownership for their clients. They're bundling in AI, they're bundling in data capabilities, and yet the renewals remain robust.
They're strong.
SAP is literally telling its customers, hey, this costs more now, and the customers are signing the check. That tells me the demand is incredibly inelastic.
That is such a key point. If they were struggling to grow, you'd see margins get squeezed as they tried to buy revenue. We are seeing the opposite. They are charging more, and customers are paying it. Which, leads us perfectly into the structural defense of this business. We need to talk about why these customers are paying more.
Yes.
We need to talk about the moat.
We call this the corporate lobotomy thesis.
I love this metaphor. It's graphic, but it is so accurate. Let's explain it. When we talk about economic moats, we usually talk about things like network effects, like Facebook, where everyone is there because everyone else is there, or maybe brand power, like Coca-Cola.
Right, the classics.
But SAP has something different. It has switching costs. And we rate this at a power level 4. That's the highest level there is.
To really get this, you have to understand what SAP actually is to a company. It's not just a piece of software you log into to check your email or organize a meeting. It is the operating system of the global economy. 87% of total global commerce touches an SAP system at some point.
87%. Just pause on that for a second. That is a staggering statistic.
It's mind-boggling.
It basically means if SAP goes down, the world effectively stops trading for a day.
It does. And when a Fortune 500 company implements SAP S/4HANA, they aren't just installing an app on their computers. They are fundamentally rewiring their entire supply chain, their financial controls, their HR processes, their manufacturing logistics, everything. It takes years. It costs millions, sometimes billions of dollars in implementation fees, consulting hours, training.
So ripping it out isn't like canceling your Netflix subscription because they raised the price by $2.
Not even close.
It's not even like switching from an iPhone to an Android, which is, annoying but doable.
No. Ripping out SAP is an existential risk. We call it a corporate lobotomy because you're essentially trying to perform brain surgery on the company while it's still trying to run a marathon. Just think about the risk for a chief information officer, CIO. If you are the CIO and you decide to switch your company from SAP to, say, Oracle or Workday, and that migration fails, what happens?
Payroll doesn't run.
Payroll doesn't run. Your trucks don't leave the warehouse because the inventory system can't talk to the shipping system anymore.
Oh, God.
The quarterly books can't be closed because the general ledger is corrupted.
And the CEO gets fired. The CIO is definitely fired. The stock crashes.
Exactly. The company might literally go under. There are historical examples of this. Companies that tried to migrate ERP systems and failed so badly, it materially impacted their earnings for years. Remember Lidl? The grocery chain?
Vaguely.
They spent €500 million trying to switch to SAP and eventually had to scrap the entire project because the complexity was just too high. Now imagine trying to leave it. It's nearly impossible.
So the risk of leaving is infinitely, exponentially higher than the pain of just staying and paying a higher price.
Right.
It's a hostage situation, but in a corporate sense.
Precisely. And that is why I look at that backlog miss with such a huge grain of salt. Does a slightly lower growth rate really mean the moat is weakening?
I don't think so.
No. It just means the sales cycle might be taking a month longer because of interest rates. But are those customers going to leave? Absolutely not. In fact, I'd argue the moat is actually widening right now because of a concept we call data gravity.
Data gravity. That sounds like a sci-fi concept. Break that down for us.
It's a concept from software engineering, but it applies perfectly to finance. So think about data like mass in physics. The more mass an object has, the more gravity it exerts, right?
Okay, yeah.
Once a company moves all their data into the SAP cloud, into what they call SAP Datasphere, or the Business Technology Platform, BTP, that data starts to accumulate mass. All your historical sales records, your customer data, your transaction logs for decades.
And it attracts more data, and then it attracts more applications that want to use that data.
Exactly. The more data you have there, the harder it is to move. You become locked in structurally, not just contractually. You can't just list and shift 20 years of transactional history to a competitor without massive, massive friction. The database schema is different. The business logic is different. So once SAP gets your data into their cloud, you are effectively there for life.
So the customers are stuck, but in a good way for the investor. You know, it reminds me of Charlie Munger's Lollapalooza effect.
It's a perfect application of that mental model. Munger always talked about how you get these outsized results, these really extreme outcomes, when multiple powerful forces all move in the same direction at the same time.
A confluence of factors.
A confluence. And here, with SAP, we are seeing a convergence of three massive forces, all acting on their customer base at once.
Okay, let's list them out. What's number one?
First, you have the switching costs we just talked about, the corporate lobotomy, the legacy lock-in. That's the foundation. Second, you have process power. This is the human element. It's the embedded workflow knowledge. The finance team knows SAP. The supply chain guys know SAP. Retraining 50,000 employees on a totally new system is a corporate nightmare.
That human element is huge. People hate change. They just hate it.
They do. And then third, and this is the real kicker, you have forced migration.
This is where SAP gets aggressive. They are ending maintenance for the legacy ECC versions of their software.
Right. They are burning the ships. There's no going back. They have basically told their entire customer base, we are stopping support for the old on-premise software. If you want security patches, if you want new features, if you want any updates at all, you must move to the cloud.
So customers don't even have a choice.
They don't have a choice. This creates this incredible feedback loop where SAP captures immense value without needing to acquire a single new customer. They just have to migrate the ones they already have held captive.
It sounds incredibly bullish for the company. I mean, it's a powerful position to be in. But it does raise a question about the relationship with the customer. If you're forcing people to move and they can't leave because of the lobotomy risk, surely that creates some bad blood. We can't ignore the friction this strategy creates.
It absolutely does. And that brings us to the other side of the coin. You cannot execute a strategy this aggressive without breaking some glass.
Right. And we can see the data on this. We check the Net Promoter Score, the NPS, which is a measure of customer satisfaction, and it has dropped from 12 down to 9.
For a software company, that is dangerously low. A score of 9 is, well, in the consumer world, that would be a complete disaster. It signals that customers feel forced into the cloud rather than delighted by it.
They feel like hostages.
They feel like hostages. They are looking at the bill, which is higher, and the migration headache, which is enormous, and they are saying, I hate this.
And the skepticism here is valid. I mean, if you treat your customers like hostages, eventually they're going to revolt, right? Why wouldn't they just bite the bullet and leave for Workday or Oracle? Eventually, doesn't the pain of staying exceed the pain of leaving?
That is the anti-moat check we have to perform. It's the key risk. If the product is terrible and the service is arrogant, eventually someone will build a better mousetrap and customers will flee. But here is where the nuance comes in. You have to look at the internal culture versus the external sentiment.
Interesting.
While the customers are grumpy, look at the employees.
The employee engagement stats.
Exactly. On sites like Glassdoor and Inside View, employee engagement actually rose to 76%. That's up 2 percentage points.
Hmm.
So the customers are grumpy, but the employees inside the company are happier and more engaged. Why is that?
That tells me something about the leadership. I think we have to talk about the CEO, Christian Klein. He's young, for a German CEO, and he's aggressive.
Christian Klein has been fascinating to watch. When he took over as the sole CEO, after that co-CEO structure ended, he basically came out and admitted that SAP had become bloated and confused. It was a conglomerate of acquired companies that didn't talk to each other.
Right.
He executed a huge restructuring that just concluded in 2025. He called it painful but necessary.
And usually when a CEO says restructuring, morale just tanks. You think layoffs, budget cuts, uncertainty. But here, morale went up.
Because the organization is now leaner, it's more focused, the engineers know what they're supposed to be building, the vision is clearer, they aren't bogged down in as much legacy politics. The synthesis here, I think, is that the low NPS, that score of 9, is a temporary symptom of this forced migration event.
It's a side effect.
It's a side effect. Think about it. Moving house is stressful. Nobody likes moving. You hate the movers. You hate packing boxes. But once you're in the new house, the cloud, and you see the benefits, the utility of the data, the speed, the new AI capabilities, the bet is that that utility will ultimately outweigh the pain of the move.
So, the low NPS reflects the growing pains of the migration, not a fundamental rejection of the product itself. The bet is that in 2027 or 2028, the NPS score rebounds because the cloud product is actually better.
That is the thesis. Now, if that NPS stays at 9 for the next 5 years, we have a serious problem. That opens the door for disruption. But if it just dips during this massive migration and then recovers as clients see the value, then it's just noise. And you have to remember, who are they going to switch to?
That's a great point.
Oracle is doing the exact same thing to its customer base. Workday is fantastic for HR, but it can't run a global manufacturing plant. The alternatives aren't pain-free either.
That's a very fair point. The entire industry is forcing this shift. Okay, so we have the context of the crisis, we have the incredible strength of the moat, and we have the friction of the transition. Now let's follow the money. We need to look at the financial resilience and the capital allocation, because this is where the story gets really, really interesting for a shareholder.
This is where the rubber meets the road. We talked about gross margins earlier, but let's look at the whole operating picture. We need to talk about the J-curve.
The margin J-curve. I feel like this is a concept that gets thrown around a lot in tech, but maybe break down what it actually looks like for a company like SAP.
Right. So in any SaaS transition, you have this J-curve. Just imagine the letter J. When you switch from selling licenses, where you get a huge check up front, to selling subscriptions, where you get a smaller check every month, your revenue or your profits initially drop. You go down into the valley of the J. And on a chart, it looks like the business is shrinking.
That's the scary part for investors who don't understand it.
Exactly. It looks like failure. But as you stack those subscriptions on top of each other, year after year, eventually the recurring revenue stream exceeds what the old license revenue used to be. And you turn the corner and you shoot up the long stem of the J-way. Margins expand rapidly because the cost to serve that software just drops.
And the key point is that SAP has passed the bottom.
They are out of the valley. Non-IFRS operating margin hit 28.3%. That is a massive jump, up 4.5 percentage points.
And that validates the whole thesis, right? It proves the SaaS operating leverage is real. The more customers they move to the cloud, the more profitable each additional dollar of revenue becomes. They're climbing the mountain now.
They are. But we have to do our due diligence. We cannot just look at the non-IFRS, the adjusted numbers. We have to talk about SBC, stock-based compensation.
Ah, yes. The tech elephant in the room.
It always is.
In Silicon Valley, they treat stock like it's monopoly money. So what's the damage at SAP? Is it bad?
It's about 18.5% of operating cash flow. So in absolute numbers, that's about 1.7 billion euros.
Okay, 1.7 billion euros. That feels like a lot of shareholder money being paid out to employees. That's real dilution. That's my slice of the pie getting smaller.
It is elevated. I won't sugarcoat that. It's a real cost. And Warren Buffett would tell you, correctly, to treat it as a real cash expense. But we have to put it in context. We have to compare it to the peer group to see if it's egregious.
Okay.
If you look at some of the high-flying U.S. tech peers, your Snowflakes, your Palantirs, even Salesforce in the past, you often see SBC running north of 30, 40, even 50% of revenue or cash flow. It's what we call a dilution death spiral.
So at 18.5%, SAP is actually being relatively disciplined for a tech giant?
It's manageable. It's the cost of retaining top talent in this sector. If you want the best AI engineers in Germany or in Silicon Valley, you have to pay them in equity. But the key is, even if you adjust for this, if you subtract that SBC as if it were a cash expense, the business is still printing about 6.5 billion euros in real free cash flow.
Real cash.
That is real money that can be returned to shareholders.
And speaking of returning money to shareholders, let's talk about that buyback. This was a huge signal in the recent update.
The cannibal buyback, as Martha would say.
They announced a new 10 billion euro share repurchase program that runs through 2027.
This is a massive, massive signal.
Yeah.
When a company buys back its own shares, it can mean one of two things. One, they have no ideas for growth. They're out of innovation. So they just financially engineer the EPS higher.
Right, the cynical view.
Or two, they believe their own stock is fundamentally undervalued.
And given the backlog miss and the sell-off, this feels like the latter. They're seeing the price drop and they're just saying, thank you very much, Mr. Market.
100%.
Right.
Management is looking at the stock price at $200, and they're saying, the market is wrong. We see the pipeline. We see the margins expanding. We're going to buy our own stock because it is the single best investment we can make with our capital right now.
It's skin in the game.
They're engaging in cannibal behavior. They're eating their own share count. And that increases the ownership stake of every single remaining shareholder without us having to do a thing.
It's the ultimate vote of confidence. I mean, actions speak so much louder than words on an earnings call.
And it also supports the ROIC story, the return on invested capital. As they retire that old asset-heavy legacy infrastructure and move everything to the cloud, the capital required to run the business goes down. They don't need to own as many of their own data centers. They can use hyperscalers like AWS or Azure.
Right.
But the profits are going up.
Yeah.
So the denominator in the ROIC equation goes down, the numerator goes up. Your return on invested capital is structurally expanding. It's a beautiful financial setup.
So just to recap, we have a company with a widening moat, it has expanding margins, and a management team that is aggressively buying back its own stock. But the question remains, is it cheap? Because a great company can be a terrible investment if you overpay. So let's move to valuation and the long horizon.
Yeah, this is the most difficult part of the puzzle because, we have to try and predict the future. Valuation is definitely more of an art than a science.
For sure. But let's start with what the market thinks. At roughly $200 a share, what is the market pricing in right now? What are the embedded expectations?
If you run a reverse DCF, a discounted cash flow analysis, which basically asks, what assumptions do I need to believe to justify this current price? The market is pricing in a deceleration of growth down to about 10 to 12% long term.
Wow.
The market is essentially saying SAP is going to become a slow growth utility. The glory days are over.
But SAP's own guidance contradicts that completely.
Aggressively so. They are guiding for accelerating revenue growth through 2027. They're projecting free cash flow to hit 10 billion euros in 2026.
So there is a massive disconnect. The market is saying 10% growth. The company is saying we're just getting started. That's where the opportunity is created.
That's the arbitrage. So let's try and triangulate the value. I don't like relying on just one method.
Smart.
If we look at historical mean reversion, SAP typically trades at about a 30x PE multiple when it's in growth mode. If you apply that 30x multiple to the 2026 estimated EPS of around $8.55, you get a share price of roughly $256.
That's a significant upside from 200. That's more than a 25% gain right there.
It is. Then you can look at analyst consensus. The average price target from the banks that cover this stock for a living is around $340.
Wow.
Which implies that this market reaction to the backlog miss is a gross overreaction.
Yeah.
The analysts are looking at the same data and they're screaming, buy.
And what about the owner earnings method, the sort of Buffett approach to valuation?
If you take that 10 billion euros in expected free cash flow for 2026 and you apply a pretty standard sauce multiple of, say, 25x, which I think is conservative for a monopoly.
Very conservative.
You get a market cap of 250 billion euros, which translates to about $240 per share.
So almost every way you slice it, historical multiples, analyst targets, cash flow multiples, the stock looks cheap. It seems like we're looking at a buy zone somewhere between 190 and 210.
Exactly. But here is the secret. And this is where a deep dive like this really pays off. Investors buying the stock today aren't just buying the 2026 recovery story. They are buying the 2030 compounder. You have to extend your time horizon.
The 2030 vision, let's talk about that, because this isn't just a trade for the next 6 months. This is an investment.
No, Absolutely not. We're moving from what we call transition economics to maturity economics. Right now, the financials are a bit messy because of the cloud transition, but by 2030, 95% or more of their revenue will be predictable, recurring subscription revenue. The volatility just vanishes. It becomes a machine.
That's the dream for a long-term investor, the rule of 40.
Management is explicitly targeting the rule of 40. And for listeners who don't know, that means your annual growth rate plus your profit margin should equal 40 or more.
A sign of a healthy SaaS business.
A sign of an elite one. They are aiming for 10 to 12% growth plus 30 to 35% margins. That gives you a score of 45 or higher. If they hit that, they justify a premium multiple forever. They become like a bond proxy that grows at 10% a year.
And there's one more growth driver we haven't really touched on enough yet, the AI tax. Everyone is talking about AI, but how does SAP actually monetize it?
Joule, that's the name of their AI copilot.
Yes, Jewel. Is this just a flashy new feature to look cool for investors, or is there real money to be made here?
This is not just a feature. This is a way to dramatically increase the wallet share of every single customer. Think of it as pricing power 2.0.
Okay.
Microsoft showed the world how to do this with Copilot.
Right.
You have the software, you have Microsoft 365. Now you pay an extra $30 a head per month for the AI that runs on top of it. SAP is doing the exact same thing. They are implementing an AI tax.
Well, why would I pay SAP for AI? Why not just use ChatGPT or some other model?
Because of context.
Yeah.
This is the critical point. ChatGPT doesn't know your real-time inventory levels.
Yeah.
It doesn't know your payroll data. It doesn't know your supply chain logistics.
Right.
SAP holds the source of truth, the actual live operational data of the company. You can't run a supply chain AI if the AI doesn't have access to your inventory data. SAP has the inventory data, so their AI is infinitely more valuable in a business context.
So the data is the moat for the AI.
The data is the moat. The switching cost for the AI layer will be even higher than for the ERP itself. Once you build all your automated workflows and business processes on top of Joule, you can never leave. And we are already seeing it happen. In Q4 of 2025, the 50 largest deals they signed all included data or AI components. The uptake is happening right now.
Okay, we've painted a very, very bullish picture, but we are prudent investors. We're not cheerleaders. We have to look at the downside. We have to do a pre-mortem.
The pre-mortem, absolutely essential. What could go wrong? Let's assume it's 2028 and the stock has crashed. Why did it happen?
What's the biggest threat in your mind? Is it macro? Is it a competitor? Is it execution?
For me, the number one risk is what I call the Oracle Workday gap. It's the risk that competitors innovate faster on the edge, on the user interface, the user experience.
TQI, yeah, SAP has always been known for being, well, ugly, functional, but clunky and ugly.
German engineering in the clunky sense of the word. If a company like Workday makes a user interface that is so much better, so much easier to use, so much more intuitive for the Gen Z workforce that's now entering the market, then SAP risks becoming just a dumb back-end database.
They lose the user engagement, people stop logging into SAP directly, and they start logging into some pretty layer that sits on top of it.
And plumbing doesn't command a premium multiple.
Okay.
If they lose the eyeballs, they lose the pricing power. They become a utility. That's a huge risk.
What about geopolitical risks? We mentioned the global nature of the business. That can be a strength, but also a weakness.
Sovereign cloud fragmentation. This is a huge headache for all global tech companies. The EU AI cloud, data localization laws. We're seeing more and more digital borders going up around data.
Yeah.
China wants data to stay in China. The EU has GDPR and the AI Act.
Right.
If every country requires its own sovereign cloud, the costs for SAP go way up. It breaks the global synergy. It turns their regulatory moats into regulatory cages. If SAP has to build a separate, isolated cloud for Germany and for France and for the US, that hurts margins badly.
And finally, there's the reflexivity risk. This is the market psychology risk.
This is the George Soros concept. If that backlog metric continues to decelerate, if next quarter it's 22% and then the quarter after that it's 20%, the market might just give up and decide SAP is a value stock.
The narrative becomes reality.
The narrative becomes reality. The multiple could collapse from 30x down to 15x. And if that happens, it doesn't matter how good the earnings are, the stock price gets crushed. And then the lower stock price makes it harder to pay employees with SBC, top talent leaves, the product suffers. It becomes a downward spiral.
That is the fear. So taking all of this into account, the backlog miss, the powerful moat, the buyback, the AI tax, and all these risks, what is the final verdict?
If I look at our quality score for the business, it's HEH. It's a wide moat company with improving margins and shareholder-friendly Cannibal buybacks. If I look at the valuation score, it's cheap. This is a rare disconnect between the current price and the long-term free cash flow outlook.
So the trade is?
Accumulate.
I agree. But let me play red team one last time. Why pay a premium multiple for what could be seen as a utility company that's just pretending to be a tech stock?
Because you aren't paying for a utility. We are paying 23 times forward earnings for a business that is growing its free cash flow at a 20% plus compound annual growth rate and is protected by the highest, most durable switching costs in the entire industry. The pain of the transition is past. The harvest lies ahead.
Well said. And that brings us to our final thought for the day. We've talked a lot about growth and buybacks, but there is one thing we haven't mentioned, and that's the dividend.
The dividend floor.
Exactly.
Yeah.
Unlike these pure growth, no-profit tech companies, your Snowflakes or your Datadog's SAP pays you to wait. It offers a carry for long-term holders. It's not a huge yield, but it's there, it's growing, and it provides a floor for the stock.
So essentially what we're looking at here is the Microsoft of 2015.
That is the perfect analogy. Think back to Microsoft then. People thought it was dead. Ballmer was gone, Nadella was brand new, it was painfully moving to the cloud, margins were messy, everyone was screaming, the PC is dead.
I remember it well.
But then it re-rated, a massive re-rating driven by the durability of cloud cash flows and aggressive capital returns. The only question for investors today is, are you patient enough to wait for 2030?
That is the question. Your time horizon really matters here. If you're trading this week, good luck to you. If you're investing for the decade, this looks like a fat pitch.
Thank you so much for tuning in to this deep dive on synaptic investing. We hope this cleared up some of the noise around SAP.
As always, this isn't financial advice. Please do your own diligence. We'll see you in the markets.
Bye, everyone.